Have you actually considered where your financial beliefs come from, or whether the advice you've trusted for years still holds up under closer examination? For millions of people, Dave Ramsey has become one of the most recognizable voices in personal finance, promoting a straightforward philosophy built around budgeting, avoiding debt, and living below your means. His message has helped countless households organize their finances and regain a sense of control. Yet it has also attracted criticism from economists, financial planners, and experienced investors who argue that some of his recommendations sacrifice mathematical efficiency for simplicity. So the real question isn't whether Dave Ramsey is right or wrong, but whether his financial advice is actually worth following once you separate the psychology from the numbers. To understand why the 15% rule exists, it's important to recognize that investing is not just a mathematical exercise. Human behavior often plays a larger role than financial knowledge. Research in behavioral economics has repeatedly shown that people struggle with consistency far more than they struggle with understanding basic financial concepts. Many investors become excited during rising markets, only to panic during downturns. Others wait for the perfect time to begin investing, believing they will start once they earn more money or once the economy feels more stable. Years can pass while they remain on the sidelines, unknowingly giving up the one resource they can never recover: time. Dave Ramsey's framework attempts to remove these psychological obstacles by replacing constant decision-making with a repeatable system. Rather than asking whether today is the right day to invest, the system encourages investing the same percentage of income month after month, regardless of headlines or market sentiment. The objective is not to predict the future, but to participate in long-term economic growth through disciplined investing. The mathematics supporting this approach begins with compound growth. Compounding occurs when investment earnings generate additional earnings over time. In the early years, progress often appears slow because returns are being earned on a relatively small balance. As the account grows, however, each year's gains begin generating their own gains, creating an accelerating effect that becomes more noticeable after many years of consistent contributions. Consider someone earning $80,000 per year. Following the 15% guideline means investing $12,000 annually before considering employer matching contributions. If that contribution remains consistent and investments experience positive long-term growth over several decades, the account has the potential to become substantially larger than the total amount personally contributed. While actual market returns vary from year to year and future performance can never be guaranteed, the historical performance of diversified stock investments demonstrates how compounding has rewarded long-term investors over extended periods. An important detail often overlooked is that the 15% recommendation comes after building an emergency fund and eliminating most consumer debt. This sequencing reflects another mathematical principle. High-interest debt can grow faster than many investments can reasonably be expected to earn, particularly when credit card interest rates reach 20% or higher. Paying off expensive debt provides a guaranteed reduction in interest expenses, whereas investment returns remain uncertain. Although financial experts may disagree about the precise order of every financial priority, reducing costly debt before investing more aggressively lowers financial risk and improves cash flow. The psychological advantage of investing a fixed percentage instead of a fixed dollar amount is equally significant. Income tends to increase throughout many careers. As earnings rise, contributions automatically rise as well, without requiring a new financial decision each year. This creates an investment habit that naturally scales with income while helping prevent lifestyle inflation from consuming every raise. Ultimately, the mathematics behind the 15% investing rule is less about finding a magical percentage and more about understanding the relationship between consistency, time, and compound growth. The specific number serves as a practical benchmark rather than a universal guarantee. For some households, it may be more than enough, while for others, it may simply be a starting point for deeper retirement planning. What remains remarkably consistent across decades of financial research is that regular investing, thoughtful diversification, disciplined saving, and emotional restraint have historically played a far greater role in long-term wealth building than attempting to predict every market movement. The deeper lesson behind the 15% rule is that successful investing is often less about discovering extraordinary opportunities and more about building ordinary habits that remain intact through extraordinary market conditions. Bull markets encourage confidence, bear markets create uncertainty, recessions test discipline, and recoveries reward patience. Investors who continue contributing through each phase avoid making emotional decisions based solely on temporary market conditions. It's that creating a system strong enough to outlast fear, excitement, and uncertainty may matter even more than finding the perfect investment itself.